Right now, Joe, we've got your 60-second question. Let's see how you do.
Hello, Joe. We certainly believe in the asset allocations. We have approximately, 40–50% in bonds. With bonds doing so well over the past 30 years, I'm very concerned that the direction of the bonds, and if perhaps we should put more into other equities.
That's a common question. All right, so you take a look at bonds. We're in a huge bond bull market because when interest rates go down, bond prices go up. So interest rates are basically at all-time lows. And so when people take a look at bonds and they're saying, hey, maybe there's a no-win proposition here because as interest rates go up, I'm going to lose money in my bonds. You have to look at bonds a little bit differently. You want to look at bonds to damper the overall volatility of the overall portfolio. Depending on what your time frames, your goals, and everything else is, you don't want to look at bonds as an income stream potentially. You want to look at it as dampening out the portfolio. You want to look at a total return portfolio. So let's say you assume a 6% growth rate on the total return. You absolutely want to make sure that you have some safety in the overall portfolio. 40% in bonds sounds reasonable. The other 60% in equities, you want to make sure that it's globally diversified. When the equities go up, your bonds are going to stay straight. When the equities go down, your bonds are going to save you. You definitely want to keep bonds in your portfolios, even in a low interest rate environment.
I couldn't agree more, Joe. Nicely said. And of course, the stock market's kind of at all-time highs as well. So it's a little difficult to know where to put your money. But the key, I would say, is just what you said, Joe, which is look at a total return. Don't look at each individual asset class. Look at a total return.